inflation, 4.3%. We're watching people who own homes tap into their equity to pull out, to remodel, to give to children, to buy homes. Maybe they're buying a second home. What's happening out there, man?
Yeah, so it's a little bit scary when people tap into equity if they're not making a move to go buy a property. So I think a lot of this is debt consolidation right now. People trying to make their home more livable for their long-term needs. Remember, rates going higher, like we've seen, creates that anchoring effect of people staying in their houses for longer. That's not super good for inventory because it means people are going to be staying put for a while, or they have red flags in their finances where maybe they didn't get their bonus they were expecting. Maybe they didn't get that promotion they wanted. So we may have people tapping into that equity to survive and to try to live in a lot of unknowns right now with what's happening in the world. So.
Interesting, man. I'm also watching a bigger separation between the corporate people, businesses, and then those people that are barely making it. I feel like the people that are barely making it, that's a growing number of people. And those people on the corporate side that are making it really well, they're making it even better than before. So it's a widening gap. It's an interesting thing to watch.
Absolutely. We have a couple big IPOs coming out in the next couple weeks. We have OpenAI, SpaceX, and a couple other ones that are going to go public. That normally means a big windfall for a lot of those employees or investors. And it's
Yep.
centric to a lot of the areas like in the Bay Area in California, right? You have a big audience of those employees. So normally it
Right.
means there's a surge of activity, and it's replacing a lot of the people that have lost their jobs, right? You had Facebook lay
Yeah.
off a lot of people. Google just sold 4 of their main campuses in the Bay Area. There's a lot of change happening where people are wanting to adapt and be flexible to whatever may come with the economy and the world situation right now.
It's interesting that you say that because, yeah, we've got a lot of people in Los Angeles that started with SpaceX at the beginning, and that's their headquarters, right, originally. So you're going to have a lot of millionaires coming in and being like, well, I guess it's time to buy a home in SoCal, right? And then OpenAI and whenever Anthropic goes into an IPO. But dude, a lot of opportunity coming up. This is why we're seeing the market in San Francisco go nuts as well. All this AI money.
Absolutely. Yeah, absolutely. There's AI money. And then you got the older people that have been in their properties for 30 or 40 years, right? They don't have really
Yeah.
anywhere to go, right? They may have a great home that's 2 stories, they no longer can live there. But to make that move to something more comfortable, it might be 3 or 4 times their monthly expenses than the current situation because either property taxes go higher or it's maybe a 55 and older community that has a lot of HOA fees. This is a lot of things shifting here. And again, being that local professional that knows the market is the key. Knowing the trends, knowing what happens in your community. And yeah, HELOCs, taking money out of properties. It can be a good thing, it can be a bad thing. And I think people need to really think about opportunity cost on whatever they're
Should
doing.
should we be worried if this trend continues where we're watching homeowners take money out of their homes more often than not? It's reminiscent of 2005 and 6 leading up to 2007 and 8. What do you think, man?
Yeah, great question. I see it as twofold answer. One is if you get a variable rate loan of any kind, you're betting on short term benefits or short term needs that hopefully don't put you in harm's way down the road. For example, right now, I'm seeing areas like in Northern California, the new builders subsidized rates 2 or 3 years ago. Now, ironically, a lot of those homeowners are selling because they can no longer afford the adjustment of the rates. So we have to think about today and also the future and make sure that you're preparing correctly. Those loans all have a payment shock qualification. So it's not like someone wasn't aware their payment was going to be whatever their adjusted rate is today, but life happens. Maybe they didn't get the bonus they expected, like I mentioned earlier. So I am concerned that people using short term debt instruments for long term decisions might not be the best approach. So on lines of credit or second loans, some of them are variable rate and some of them are fixed rate. And it's really important to know the differences in those approaches. If someone's getting a fixed rate loan, I feel much safer for them because they're going to be paying a principal and interest payment on a second loan. A line of credit is a variable rate loan that has an interest only payment, and that's like a glorified credit card.
Yeah,
So make sure you have a really solid plan around whatever your long term debt plan is. Make sure you have that thought about today and have a backup plan or a best case, worst case mindset on those
got it.
ideas.
So you're telling me not to date the rate. You're
Yeah, I'm
telling
not a
me
big fan of it. Yeah, I'm
you're
married.
telling me to marry the rate and make sure
Yes,
that you're in a long-term commitment here and plan for the many years. I like this, dude.
exactly. Exactly. And again, thinking about long term fixed loans, if rates go lower, you can always refinance. There's no prepayment penalty on lines of credit. There's no prepayment penalty on conventional loans. So play it safe, see what happens, make sure you have peace of mind. Too many people with variable rate mortgages worry about rates adjusting. And I always tell them,
Yeah.
how many hours a month are you worrying about this? Oh, I think
Dude,
about
all
it
the
20
time.
hours a month. And then you look at the difference between a fixed rate
Yeah.
loan and a variable rate loan. Maybe it's 1% difference on a $300,000 amount. That's only like $240 a month of payment difference. So if you take 20 hours of worrying divided by $240 of difference in savings, that's less than minimum wage to worry about this variable rate loan. Just fix it and not worry about it. If you're stressed that much about that 1% difference, you probably shouldn't own the property anyways. You should probably think about selling or doing something else, downsizing, renting, those kind of things. So we do our best to educate borrowers to show them not only today, but in the future. And lines of credit can also be done on owner occupied properties, second homes, and investment properties. And those line of credits can be up to $500,000. So you really want to get to know what your blended rate is on your debt exposure
Mm,
before you do it. Maybe you have a large first loan at 2%. Well, if you get a bigger second loan, you have to look at that blended cost of borrowing. We do that all the time. That's what I love to do is make sure people understand because sometimes people are stuck in I have a $150,000 loan and my rate's 3% and I want a $500,000 line of credit at 8%. Well, that blended rate might be more expensive than just doing a refinance on your first loan to give you one lower overall blended rate on all your debt. So all those
mm.
things are some of the psychology that goes into financing.
Hey Jim, I wonder if we can we can change the show because I see where we're going. And I think this is we need this for real estate, more for agents, right? There's a lot more real estate agents than mortgage brokers. Um, I wonder if we do weekly, maybe like 15, 20 minutes, same
Sure,
time,
I'm in.
and then we we choose a topic like you just did, but we also expand on it a little bit more and kind of give like what's actually going on in real estate and mortgage. So it's kind of
I
like with
would
Joe
love to do
Sharp
that.
and all.
I would love to do
Let's
that,
do
and also bring in some experts like CPAs, financial planners,
yeah.
people that are important keys. Like we've talked about before, there's like 5 or 6 different people that need to be part of that decision around real estate, right? The
Let's do
realtor,
that,
the
man.
lender, insurance, all that
Let
stuff. So let's
let's
bring in
start
guests.
okay, let's start planning it not next week, but the week after that. Let's start doing that every week. And if we don't have a guest, just you and I can talk. I mean, I've got that cool those cool charts that I created that
I
update
love that. Yeah,
automatically. So
I
let's
love
do
it.
that. Let's do like 20 minutes. You good with that?
I love it. Yeah, I'm good with
All right.
that. And yeah, I got to go catch some big waves right now. So I will.
Yeah, that's right. I have a board meeting. I have a
I have
board meeting.
another board meeting. I have tons of board meetings all the time. It's
This is the
just
best. It's the
endless.
best.
Thank you.
Thanks,
Take care,
everybody.
everybody.
Thanks, Jim.